this is a pretty good data set that we're using here. So let's start off with this. We are a seed investor. So for those of you in the crowd who have already raised $50 million and you're worth $1 billion, well, first raise your hand up. I want to see. No? Okay. This is not relevant. This is for smaller companies. We're talking about companies where it's you and maybe 5 to 10 other people. Maybe you have revenue, maybe you don't. That's really what we're talking about here. Okay? Good. So let's get going. So the first thing we're going to talk about is market. Almost all VCs, and most people know this, they're looking for a really large market. But there's more to it than that. Almost everyone comes to us, and I see this all the time, in almost everybody's pitch deck, they say, we're going to attack $1 trillion market. Here's your first hint. Don't do that. It's a bad idea. Why? It really tells us that you don't understand what you're attacking. Startups don't start with $1 trillion markets. They start smaller and build up. What you need to have is a vision to attack a very large market, but your initial target, what you're going to start with, is actually fairly small, something you can conquer and win at. They're customers that you're going to uniquely be qualified for. Then, as you gain money and size, you're going to expand back out to that vision. It's referred to as the hourglass. Big vision, smaller immediate implementation, expanding to the bigger vision. So your initial market is probably not $1 trillion. Your vision might be to go after that market, but it's not going to start there. So my first statement to you is be accurate with the problem market you're solving. And let me give one more definition to this one. People come to me and they say, let's say this gentleman here, he's building a piece of HR software. Congratulations. Building HR software. His software allows you to hire people more efficiently. And he comes to me and he says, the HR software market is $50 billion. Is that really his market? No, he's just doing a small piece of that. He's doing the software that helps you hire. So his market is HR software that helps you hire. The second thing is his company today is only in Bulgaria. So it's the HR software that helps you hire in Bulgaria. That's actually his initial market. His vision might be to help people work in a better way. And that might be a much bigger market. So the first thing about market is, yes, all VCs, we don't get involved with companies unless they can at least exit, we're hoping for $1 billion, right? This is what you heard yesterday from the Angel Invest and a few other people before. But you don't have to be foolish when you present to us on this. You can say, this is my vision, but here's what I'm doing today. So be realistic with your market, but have a vision for the bigger one that allows the VC to believe you can achieve it. That's what market size actually means. That's what we're really looking at when we say market size. Just giving us a slide with a whole lot of zeros and a number on the left doesn't mean anything to us. Anybody can make that number up. That's not the skill. The skill for you is to know what you can attack and how much that's going to be worth in the future, and knowing how you're going to do it. That's what we care about when we talk about market size. Okay? So that's the first concept of market size. The second one we talk about is, should it be competitive or not? Okay, quick survey. You ready? Everybody get ready. Do you think we want one that's uncompetitive, no competitors, or one that's competitive? How many people think we would prefer non-competitive markets? You're going to get in something where there's nobody else in that space. How many people think? Raise your hand. Can you raise your hand? Raise your hand. Come on, you can be brave. Raise your hand, raise your hand. All right? We actually want a competitive space. Yeah. Why? Here's the thing. Uber, Airbnb, they didn't enter non-competitive spaces. It was very competitive, but they had a unique way of winning the customer. What that means to a VC is that there is existing customers, existing market definitions, a large group of people who, if you can win with a unique way, will rapidly move to your product. If you are creating a completely new category, you have to teach everybody out there what that category is. You've got to train them. It's a small thing to begin with because nobody understands it. Competitive markets means that people know how things exist. If you have a superior product distribution, you can win faster and we're going to talk about why faster is very relevant. It's not that you can't win. It's not that you shouldn't attack things where people aren't. It's that it takes a lot longer. Into a VC, that's more risky. Because he doesn't know how many people will pay $1 for some Snapchat story. Okay? So we are looking for big markets, but we know you're going to attack something small to begin with and then expand. We are looking for competitive only because it makes us know that you have a customer base that's there, that has a problem. And now we move on to the next part, the team. The team is something we look at very carefully. The earlier your company, the more important the team is. Because the fact is, your product is going to change. Nothing is what you predict. I can't predict what I'm going to be doing tomorrow. I certainly have no idea what a startup's going to do next year. And neither do you. But the team can adapt. If you're skilled, if you're competent, you can adapt. For that reason, we look at 3 different areas for the team. The first is the skill. If your company, your competitive advantage is, say, artificial intelligence. You say, we're going to build artificial intelligence for this hiring company. This young lady here, she's building a hiring company. She's going to build artificial intelligence for it. You better have a good artificial intelligence engineer. If the key advantage, the way at which you are going to win, you better have strong skill sets in that area. You will never have every skill set. You will never have it. You cannot possibly have the perfect team. It isn't possible. You focus your team on making sure that the key things for your victory, the way you're competitively going to win, that those are the people you have great skills on. The rest, okay, you need some. You also need someone who can present the company. No matter how you're choosing to compete, whether it's by product or distribution, you're going to need those skills. But you're also going to need someone who can talk about your company. If you can't, or someone can't talk about the company, you can't fundraise. It's hard to survive. It is one of the most consistent skills we see in our winning companies, is that somebody has the ability to talk effectively about the company. For fundraising, for talking to the press, for getting up on stage. Okay, hopefully better than me, but they need to be able to communicate about the company. So, the key thing for victory, whether that's sales and marketing or whether that's product, whatever that key thing is, that skill, plus a public speaking or ability to communicate skill. The second thing we look for is traits. This is passion and persistence. And the thing about this goes something like this. There will be a moment in your startup when things are difficult, when things are tough, when even your mom asks you if you should be in this. It's going to be that way. It is for every single company. Do not read TechCrunch and think that that's the world. It's not. I've been through many companies, 8, 9. There's always that moment of difficulty, if not many moments of difficulty. Those who are passionate and persistent will survive, and we know that. We are looking to see if you will survive the downturn, if you will survive the fight with your founder, if you will survive someone hacking your website, or if you'll just give up. Because if you're going to give up, we lose our money. So we need to know that you're going to be persistent. And you will see VCs ask a lot of questions to check on that, to see, can you survive a downturn? Because it's going to happen. And the side part to that is if you've done an exit. Anybody who has done a successful exit to us means we know that you know how to play the game. Means if we invest money in you, since you've already done it once, we're not giving you money to learn, we're giving you money to execute. And that's more efficient. So we're looking for people who have experience because it's more likely that you'll spend the money more efficiently. And the last part to this, why you? Almost every VC will ask you this question. Why should I invest in you, or you, or you? Why not the other 10 teams? Every idea you have, I guarantee I've got 10 of them. There is no idea I get where I don't get 10 of them. The companies who get funded are because there's a distinctive reason why that team is going to win. They have access to more capital, they have a better team, they have government officials on their side, they know how to do certain things. There's a reason why they will win. I'm not betting on the second place person. I'm betting on the winner. So you need to explain to me in these conversations why you and your team are uniquely qualified to win. Not solve the problem, win. Different. Solve the problem, I'll have 10 of those. There's only going to be probably 1, maybe 2 winners. Okay? So we've covered a bit about the market, we've covered about the team. Let's move on to the third part. How are you going to compete? You always get asked, how are you going to win? What's your competitive advantage? What's your unique value proposition? There are many ways to do this. You might have a superior product. It might be 1/10 the cost. It doesn't have to be that. It can be dozens of different things. This gentleman over here, maybe his thing is that he's going to sell to a different target market. Everybody else is selling to people 35 and older. He's going to target 18-year-olds. And that's a big market. She's deciding she's going to sell to Africa. Nobody's selling to Africa. A different geography. Branding. This gentleman right here decides he's going to start a company. He is fashionable. I mean, look at him. He's fashionable. Right? He says, I'm going to form a fashion brand that people identify with. You can win with that. Anybody check all the fashion brands out there? Are they really superior products? Probably not. But they get a lot of money. How are you going to win? There are about 10 of these. You can look up the whole list. There's things like channel, product, cost, distribution, brand. Know which one it is. And back to the previous slide, make sure your team can support it. If you're going to win by price, you better have the team to drive that price down or drive your costs down. Okay? So however you're choosing to win, make sure you can win with your team and the market you're attacking. Those two need to be paired up. Okay? Okay, so you figured out how you're going to win, you've assembled your team, you're going after a market, you're smart enough to know to target the smaller one and grow. What's next? The product. The product that we look at, how we look at your product, especially at seed stage, is actually just a few characteristics. And the reason goes something like this. We're dumb. Okay, let's face it. VCs, we're not going to know your business that well. So what we're looking for is an indication, something that tells us your product is awesome without us having to figure that out. Because we're also kind of lazy and kind of busy. So fast to cash basically means this. Let's assume this young lady over here, she starts a company, and all of her customers pay her upfront for 2 years. She's selling a piece of software, they pay her upfront for 2 years, $10,000. What does that tell me? The customers are perceiving that her product is useful and viable. We have basically gotten a validation that at least they perceive it's a product market fit. How much mental energy did that take on my part to figure it out? 0, right? So when you go out and you can get people to pay you up front for your product, even if it doesn't exist, that's a clear indication to us that the customers are perceiving that it's valuable. And that makes it much easier for us to invest. This is an indication of product market fit. The second thing is we talk about the 10x advantage. I'm going to make reference to the last slide on competition. I want to be careful. 10x does not mean 1/10 the price. 10x could mean a brand or a perception or a target or a geography. But to the customer you are targeting, to whoever you are targeting, they perceive something about your product that is substantial and significantly better than their alternative option. That's what we're talking about. If it is only a little bit, people won't take the risk. And I want you all to think about yourselves right now. Tomorrow, a new cell phone company ships a product, and they tell you it is awesome. It is just as good as your iPhone, and it costs $50 less. Would you buy it? Raise your hand. How many people would buy that? $50 not worth the risk. Okay, it's $20 instead of $1,000. How many people might seriously think about buying that phone now? Yeah, if you've got your hand down, yeah, okay. Come on. If it has to be that big when you're a startup because you're based against that friction that is our lives, which is our habits, our daily thing about not having to deal mentally with something new. That's what 10x is about. It's big enough that your customers perceive it to say, wow, I need to think about this. If you're not there, whatever that is, you're not going to win the game. And you're not going to grow fast enough to interest a VC. That's what that means. 10x is a simplification of that statement. It's not actually 10, but it's that concept that it's so big, it's so significant that people reevaluate their decisions because of what you offer. That's what that means. However you achieve that. The third part I want to talk about is called a Net Promoter Score. A Net Promoter was actually defined earlier in this, I think yesterday, and I think a couple of speakers have mentioned it, so I'm not going to go through a lot on it, but it basically means this. If you were to survey your customers, the number of people who scored you on a scale of 1 to 10, a 9 or a 10, minus all the people who scored you 6 or less. A plus 50 indicates to a VC you have a product market fit, that the existing customer base believes your product is awesome. So therefore, if you think about what it says to us is that's a product market fit with your target market. That's a huge amount of, much less, it is a tremendously easier decision for us to move forward with this. You've proven to us that your customers love it. By the way, if your Net Promoter Score is your mom and your uncle, that doesn't count. It does need to be at least somewhat sizable, and they need to be paying you money. If it's a free product, it's not that relevant. So, if you have a great Net Promoter, as a VC, I go, wow, they have a Net Promoter. That means customers love them. That means those customers will buy from them again. That means those customers, when they go to do marketing, will add to their virality index, will help them market because they love it. How many people have tried to sell you an iPhone? They don't work for Apple, they just love the product. Drives me a little crazy, but nonetheless, that's what you want. You need those Net Promoters to survive as a startup. To a VC, again, easy decision making. It tells me you have product market fit and that people love your product. Fast to cash tells me your customers perceive they're going to get the value. Net Promoter Score means that they are getting the value because they're actively using it. Those two in combination do really well to help us decide your product is good and worth funding. Okay, so now we've got a product. We're going to move on to the next part. Is this a VC business? Many, many good businesses are not VC businesses. There's only a small section that are. This doesn't mean the business is bad. It might be a great business. VCs look for a very specific category of investment. So let's explain it this way. A VC fund has a 10-year lifespan, 10 years, almost all of them, which means I raise funds, I get in a bunch of money, I invest in seed stage startups for the first 3 to 4 years. The next 4 years, I do additional money for my previous investments, no new investments. And the last 3 to 4 years, I'm not investing. So when they put money in you, they have about 6 years before they need to repay the money to their investors. So you need to exit in 6 years. They need to be able to get out in 6. Honestly, a lot of businesses, that doesn't work that way. So it's just not a VC business. There's nothing wrong with the business. It just doesn't work for this person, the VCs, lending money or giving money to you because they need their money back. Okay? Your mom will probably be more patient, but VCs not so much. So the first statement is to understand is they themselves have a return they have to do, which is a timeline. The second is they need to win a big enough number. This was explained in the earlier one. A majority of our investments go to 0. So in order for us to return enough return where we're still employed, we need a handful of very big winners. So we're only really interested in big winners. For that reason, we're interested in very rapid growth that can be exited in 6 to 10 years, that has a high enough value or multiplier that we can get 50 to 100x our money on a big winner. Bluntly, that's a very small number of companies, right? So when you approach a VC, you have to imagine that that's the formula they've got in their head, and they're asking, can you get there? Can you get there? Can you and your team get there? Can you grow fast enough to achieve that? Is your market big enough to accommodate that? Can you move outside of Bulgaria quick enough to make that happen? That's the question they're asking. Are you a VC business? It's very much about the rapid growth, very much about a big enough margin, a big enough value that they can get a large multiplier when they go to sell or when they go to exit. And the last piece is control. And this, for a lot of people, including people like me who is an experienced entrepreneur, I may choose not to take VC money because they're going to exert control. A VC wants 10 to 20% of your company. They want board seats. They want to make sure they can get their exit in that 6-year timeline. They're going to exert control. This is very difficult for some people. They don't like this. So here's my statement. If you don't want that influence, don't take the money. That's the deal. That's the deal with the devil you're making. Don't fight about it. Understand it's coming. I'm not saying make a bad deal. I'm saying understand there will be some negotiations that has to happen. If you don't want that, don't take VC money. 500 startups is very passive. We exert almost no influence whatsoever because we're all entrepreneurs and we feel like that's not positive. We are a minority. Most VCs will exert influence. So you need to be ready for that. Make sure you've negotiated and you've talked to the VC about it so that you are successful with it. But for a VC business, you need to accept that that's going to happen. Okay? As a small side note, the more successful you are, the faster you're growing, the less influence the VC can have because you don't need them. The best way to get money is when you don't need it. All right? If the only time you ever call your parents is to ask for money, they know what that call is. It changes the relationship. If you're very successful, the VC wants to give you money. He wants more of your company and you don't want to give it. That's the best position. So the best way, if you're going to take this money and you don't want a lot of control, is to get a substantial amount of growth before. Okay. Let's move on to traction. So for traction, they're going to look at a series of metrics. The metrics that we're looking at is revenue, that'll qualify the investor. So investors were seed, so at over $1 million, we're not interested. The second thing is growth rate. We're looking for really about 20% month-over-month growth rate. I've talked a little bit about this already, so I'm going to cover this more quickly. We're looking for this 20% month-over-month, this constant growth rate. That's how we make money, is on your growth rate. So we're looking for fairly high growth rate. The third piece is LTV to CAC, long-term value divided by cost of acquisition. If you don't know what this is, please do look it up. It's very important. You will always get asked about this. How much does it cost to get a customer, and how much do you make, and how fast do you get money? Because that tells us how much money, what's called CapEx, how much money we need to contribute to have your business succeed. The last two parts are high margin, which is obviously preferable, and churn. Churn is actually very important. You need to know what your churn is. If you start with 100 customers in January, how many of those are still with you in December? It's important because if you have a high churn, you've got to keep getting new customers, you've got to keep paying for more acquisition. Most VCs will spend a lot of time talking about your churn because it also indicates whether you have product market fit. If you have 100 customers at the beginning of the year and at the end of the year, none of them are with you, do you have product market fit? Probably not. Probably not. That's the indication. Again, I don't have to be smart. I don't have to know much about your business to know if you have a high churn that you've got a problem. It's a lot of cost being wasted. Once we get past traction, we're going to talk a little bit about CapEx. CapEx means money. If you're going to build an atomic rocket, a nuclear rocket, and you need $100 million, and we write $100,000 checks, it's not a fit. We can't fund you enough. CapEx is a matching process between how much money you need and how much money they write. Most VCs, lead VCs, want 10 to 20% of the company. Followers want about 5%. If their check doesn't cover that and won't get you to your next milestone, to your next round, they can't fund your company. So if you're asking for 10 million and they write $100,000 checks, they're not interested. If you're asking for 500,000 and they write $10 million checks, they're also not interested. They can't write that small a check. It's not worth it. So there's a matching process to how much you need to win, to defeat your competitors, to grow, and to accomplish your next milestone. And the last part to that is you need to understand what happens with your math, because they will always ask you, if I give you more, if I give you less, what happens, where are you going to spend it, what's it mean? LTV to CAC, that ratio is very important with that discussion. So know what that means. Don't worry, we're almost done. You almost get to your break time. You need to also be ready for when they give you money. What this comes down to is this. Do you have control of your sales process? Can you repeat it? Do you know how to grow if I give you money? Same thing with your marketing dollar spent. Please do not say this. This is the terrible thing to say to a VC. I'm raising $1 million so that I can go out and hire a sales and marketing person so I can go and get revenue. Terrible. Please do not say that. Instead, you say, we ran this series of experiments. We know that SEO will generate $2.5. We expect to hire a chief marketing officer who hopefully will improve on it. Therefore, $500,000 will generate this much money for us. You should have a clear indication of how and what is best to spend that money on before you get it. That's the sales and marketing side. The third side to it is on your product. You should be able to show product market fit as net promoter score, right, or early payments. The next part is you need to have financial controls. Most of them will insist that you have an accountant, bank accounts with 2 signatures, something that says you're not going to take the money, go buy a Lamborghini, and go drive off to Malta. Yes, it's been done. Last part to that is engineering. Code must be checked in. It must be in a place where if your engineer quits, he takes his laptop home and the whole company goes away. We want to make sure that that doesn't happen. Yes, that also has happened. So understand that they're looking for processes in place to scale your company. On to the last part of this. We're almost done. Last question. Why now? This is a really important question. Whatever idea you've had, people have had it. Why didn't it work in the past? And the reason we want that question asked goes something like this. If you can't come up with a good answer to this, it has been tried and they've been failing, you just don't know about it. So for a VC, it's very risky to invest in any company that can't answer the question, because it means lots of people are trying it and it's lots of failures, you just don't know about it. Because somebody's had these ideas. Trust me, we get 10,000 applicants. I can't tell you how many of them say they have a revolutionary new idea, and then we send them 5 links over the last 10 years of companies that have tried it and failed. This happens all the time. You need to say why now. A new piece of technology, a new thing that's enabled. If you can't answer that question, your next job is to look back and figure out who did it and why they failed and why you're different, or you will not survive the interview. We're pretty much out of time. So I do hope I provided more useful information than just the stretching at the beginning. I hope that wasn't the actual most exciting part of the talk. But I don't think we have time for questions. We have 5 minutes for questions? All right. So we do have 5 minutes for questions. So if anybody has a question, I obviously can't see you because I have a bunch of